Now, last chapter of accounts syllabus, cash flow statement. This chapter again will have 4 marks question in board exams and very scoring, like chapter 4, 5, last 2 chapters of accounting. This one is also very scoring. Before we understand what is cash flow statement, first we understand what is cash. Then we'll understand what is cash flow. And then we will understand what is cash flow statement. Stop talking. Now, what is cash? You may find it very funny, but your definition of cash and Accounting Standard 3's definition of cash is different. Here this cash flow statement is to be made as per Accounting Standard 3 and from 2004. April 2004 it has become compulsory for every joint stock companies to make cash flow statement. When I come to the third point, I'll explain that again in detail. But first of all, what is cash? In this chapter, when we say cash, it means cash and cash equivalents, which we studied in final accounts also. But there we had only 2 items in cash and cash equivalents. Which 2 items? Cash in hand, there is cash balance, and cash at bank, there is bank balance. Okay, that will be included only in cash. Cash itself includes cash in hand as well as cash at bank, because whatever is your bank balance, anytime you can withdraw and convert into cash, so it is as good as cash balance only. Cash equivalent means highly liquid investments which can be on the spot converted into cash. There are such investments. For example, there are liquid funds and mutual funds where you get the money in T plus 1 day. T means transaction. Today you do the transaction plus 1. Tomorrow you get the money in your bank account. Same way, there are treasury bills which are issued by RBI. Whenever you want the money, even before maturity, you can sell it and next day you'll get the cash for the same. Such kind of investments are called highly liquid investments and they are included in cash equivalents. Is everyone of you clear with this? So in this chapter, when we say cash, it doesn't mean only cash in your business. It means cash and cash equivalents. It means cash in hand, cash at bank, and highly liquid investments. Is everyone clear with it? Now, cash flow. Flow means changes. Flow means changes. 2 types of changes in cash are possible. One is cash comes in, inflows. Second is cash goes out, outflows. So one is positive changes where cash comes in, cash inflows. The other is negative changes where cash goes out, that is cash outflows. So cash flow means changes in, cash flow means changes in cash and cash equivalents. Cash itself means cash and cash equivalents. So cash flow means changes in cash and cash equivalents. And cash flow statement is the statement showing changes in cash and cash equivalents. Now, why this statement should be prepared? Where does cash appear in the financial statements? Balance sheet. Balance sheet has a limitation that it shows a static view. Last chapter I discussed in activity ratio flow concept and static. Flow means, flow concept means in stock turnover etc. I discussed that numerator is flow, so in the denominator we take average stock to convert static into flow. Means what?
Many times
During the year between April to March, profit and loss account is a flow statement because it shows all the incomes and expenses during the year between April and March. But balance sheet is a static statement. It shows your financial position only on 31st March. What was your financial position on 30th March can also not be known from balance sheet. It will show only the position on 31st March. This is the limitation of the balance sheet. Now we are interested in knowing the changes in financial position from April to March. Last year's balance sheet, you can get the financial position on 31st March of last year. Current year's balance sheet, you can get the financial position on 31st March of current year. But shareholders are more interested in knowing what has happened between the two dates. Between April to March, the financial position has changed in what manner? For that we make one more statement which is called statement showing changes in financial position. And there are two types of statements. Statements showing changes in financial position are of two types. One is cash flow statement, the other is fund flow statement. Fund flow statement is not covered in your syllabus. You have only one statement of changes in financial position, that is cash flow statement. So what does cash flow statement show? Statement showing changes in cash and cash equivalents. Why do we have to prepare this? Because balance sheet shows a static view. It shows the financial position only on 31st March. But what are the changes taking place in financial position during the year can be known by making two statements, cash flow statement and fund flow statement. Suppose if you see last year's balance sheet and you find cash is 80,000, and from current year's balance sheet you find cash is 79,000. Means during the year cash has gone down by 1,000, but how? How has it decreased by 1,000? Due to which various reasons has it increased? Due to which various reasons has it decreased? All that can be known from cash flow statement. And it is very useful for equity shareholders to decide should they remain invested in the company or not. Because they have a right to know where is the money spent and where is the money earned from. So from this statement they get insight into the cash activities of the business. They come to know whether cash is misused or not in the business activities. So from 2004, as per Accounting Standard 3 issued by ICAI, for every company which is listed with SEBI, Securities and Exchange Board of India, they have to compulsorily make cash flow statement. When they give the annual report to the shareholders, three things are to be included: profit and loss statement, balance sheet, and cash flow statement. Compulsory. Is everyone clear with this concept? Any doubt with this? So let us first write down these three. First, give the heading cash. Cash means cash and cash equivalents. Next paragraph. Cash includes cash in hand and cash at bank. Next line. Cash equivalent includes highly liquid investments which can be immediately converted into cash. Got this, everyone? Now give the heading cash flow. Cash flow means changes in cash and cash equivalents. Full stop. There are two types of cash flows. Dash cash inflows and cash outflows. Did you understand this?
Yes.
Now give the heading cash flow statement. It is a statement showing changes in cash and cash equivalents. Is everyone clear with this? Now, be attentive. Cash flow statement will include the changes in cash due to three activities. Okay, cash flow statement will include changes in cash and cash equivalents, which we will bifurcate or classify into three activities. One is operating activities. Second is investing activities. And third is financing activities. So, whatever are the reasons possible for changes in cash. Whenever I say cash, now understand it means cash and cash equivalents. I'll be using the word cash only now. Cash and cash equivalents. Very long term, I'll be using only cash. Okay? So, whenever I say changes in cash, it means cash and cash equivalents. There are three reasons responsible for changes in cash. One is operating activities, second is investing activities, third is financing activities. Operating activities means activities related to business. Purely business means buying and selling of goods and services. So sale of goods you can say is inflow, you get the money when you sell the goods. Purchase of goods is outflow. Payment of wages, payment of salaries, telephone bill, electricity bill, advertisement expense, carriage outward, discount. These all are inflows and outflows related to operating business activities. Okay. Whatever comes in trading and P&L account, generally majority of those items are because of operating, not 100% items. Majority of the items of trading and P&L account are because of operating activities. Okay. Investing activities means related to assets. So purchase of land and building is money is going out, it is due to investing it. You are investing the money in land and building. Sale of furniture, money comes in, but that is again because of investment. That is not your business activity. Business activity is buying and selling of goods and services. If you're buying and selling assets, it is considered as investing activities. Okay. Buying the investments, government securities, that is also investing activities. Selling the investments is also investing. Interest received on investment is also investing activity. It's not your business activity, though it comes in P&L account or credit side. Therefore, I said, not all the items of trading and P&L account are because of operating. Interest received on investment comes in P&L credit side, but it is not because of operating activity. It is not because of business activity. It is because of investing activity. Dividend received on investments of shares, that is also because of investing. If you sell the assets, you'll earn profit or incur loss. That also comes in P&L account. Profit on sale of asset, credit side. Loss on sale of assets, debit side. But that is also not your business activity. That is your investment activity. So all the items of trading and P&L are not operating. Did everyone understand this? Investing activities means wherever money comes in or goes out related to assets. But everyone, particularly fixed assets, non-current assets. Okay. Non-current means it will include investments also. Now, financing activity means wherever money comes in or goes out related to borrowing of money and its repayment. Wherever money comes in and goes out due to borrowing and its repayment. So, for example, issue of shares. We are issuing the shares in the market, but we are getting the money. That is financing activity. Issue of debentures. Financing. Redemption of debentures. We are repaying back the money. Financing. It is also included in financing. Borrowing of loan, repayment of loan, financing. Even in P&L account, we specifically have the heading of finance expenses. Interest on loan, interest on debentures. They also come in P&L account, but they are not related to business activities. They are related to borrowing of money. That is financing activities. Did you understand this all, everyone? These three we are going to study in detail. Main cash flow statement includes all the three. But for 4 marks only it is there in your syllabus. So they'll ask you individual item. Mostly it is expected that you'll get internal option also in board exams. Means they'll ask you one question of operating activities and option they may ask you investing or financing, something like that. Did you understand it? But they'll ask you any one activity for 4 months. However, we'll be solving one question in the class where we'll make full cash flow statement also and all the three included in the same. But for 4 marks it is not expected. It is just for understanding. We'll be doing it in the class. So these 3 things we have to study in detail. Today we will just understand how to find cash flows due to operating activities. Its examples we will take up tomorrow. So write on this complete. Who are writing it still, raise your hand. So 3 activities we will study broadly in this chapter. Now, be attentive. As per AS3, to find the cash flows from operating activities, we don't have to catch the nose directly, we have to catch it indirectly. Means, one is a simple way of finding the cash flows, inflows minus outflows. We will be doing that direct method in investing and financing. But only for operating activities, AS3 has made it mandatory to follow indirect method. What is that indirect method? I'll explain you with the help of one example. Then only you'll be able to remember the format. So listen carefully. Suppose I make combined trading and P&L account. Let us say in that there is sales of 10 lakhs, purchases of 6 lakhs, wages of 2 lakhs, then you can say gross profit will be 8 lakhs. Sorry, 2 lakhs. Now, 10 lakhs minus 8 lakhs, 2 lakhs. Now, suppose you have interest on investments of 10,000. Let us say you have dividend received on shares. Silence! Dividend received on shares 13,000. Received. Let us say profit on sale of machinery 12,000. Then you have first administrative expenses, let us say salaries 60,000. Then rent and rates 20,000. Then selling expenses, let us say advertisement 50,000. Then carriage outward 10,000. Then after selling expenses, finance expenses, let us say interest on debentures 12,000. Then other expenses and losses, let us say depreciation 8,000. Silence everyone. Understand these points, they are very important to remember this format of operating. Then loss on sale of furniture 3,000. Then let us say goodwill written off 2,000. Okay, now if we find the net profit, then 2, 10, 20, 30, 35, 2,35,000 minus 60, 80, 130, 140, 150, 160, 165. If we subtract, then 70,000 will remain to net profit. Okay. Now, 70,000 is the net profit. Now, first of all, from this trading and P&L account, let us demarcate between operating, investing and financing, or which all are not related to operating and related to operating. Sale of goods is related to business.
Yes.
Purchase.
Yes.
Wages.
Yes.
Salaries.
Yes.
Rent and rates.
Yes.
Advertisement.
Yes.
Carriage outward.
Yes.
Interest on debenture.
No.
Which activity?
Finance.
Financing. Depreciation.
No.
Invest in that.
Now be attentive. Depreciation is not related to any of the three. Basically, depreciation, cash does not go out. It is not an item of cash flow. Depreciation is only decrease in the value of an asset. Cash neither comes in nor goes out. We call such expenses as non-cash expenses. We debit them in P&L account, but money neither comes in nor goes. And there are many such items. Bad debts reserve. You are just making a provision. You are just keeping aside the profits. No cash. Debtors are not taking away your cash. No cash is going out or no cash is coming in. So there are many such items which we record in P&L account which are non-cash. Did you understand this? Loss on sale of furniture, investing. Written off are also non-cash, because if Goodwill is of, let us say, 10,000. Life is 5 years. Then 10,000 divided by 5. Every year we write off 2,000. But no cash is coming in or no cash is going out. All the written off, and in company final accounts, what do you call written off? Amortized. All the amortized amounts are non-cash. Gross profit is because of operating only the balance of this. Interest on investment. Investing. Investment. Interest on investment is investing activity. Dividend. Investing. Profit on sale of machine. Investing. Okay. Now, one way to find your cash flows from operating activities is direct method. Direct method means straight away you take inflows minus outflows. For example, 10 lakh is inflows minus 6 lakhs two lakhs 60 20 50 10. That's it. So 6 8 860 880 930 940. 10 lakhs minus 940. So what is this? What is this? 60,000 cash flows from operating. Now, the other is indirect method. Catching the nose indirectly. What we do is net profit of 70 is already obtained. In that, all these are already added, credit items, and all these are already subtracted. Now, whichever are not related to O, cancel them. Reverse. In obtaining 70, what did we do with this 12, 8, 3 and 2? Minus. Now you cancel it by adding it back. You directly start with 70 and you cancel the items which are not related to operating activities. 2,000, then 3,000, 8,000, 12,000. So 72, 5, 83, 95. And same way, these things are added. Now if you remove them, you will minus 10, 13 and 12. So 10, 20, 30, 35. 95 minus 35?
60,000.
60,000. So, as per AS3, we have to follow indirect method. Is everyone clear with this? Because profit and loss account is already made by the company. So we have to follow indirect method, and whichever things are not related to operating activities or business, we do cancel them by adding it and subtracting it. Is everyone clear with this concept? So let us understand this by indirect method. Give the heading by indirect method. Now be attentive. See, we have to start with net profit. If net profit is directly given, well and good. But if net profit is not given, then we will find it as closing balance of profit and loss account less or minus opening balance of profit and loss account. In case if profit and loss account is not specifically given, Then take reserves and surplus. Because in company final now, where do you transfer the profit or loss? Reserves and surplus. And we have done many questions where reserves and surplus included only one thing, that was profit after tax. So either you will take closing balance of profit and loss account. If it is not given, then reserves and surplus minus opening balance of profit and loss account. If it is not given, then reserves and surplus, and what you will get is net profit. Did you understand this?
Yes, sir.
Okay, so first we have to start with net profit. If it is directly given, well and good. If it is not given, how will you find the net profit? Closing balance of profit and loss account or reserves and surplus minus opening balance of profit and loss account and reserves and surplus. Now, all those items which are debited to P&L account but not related to operating, we have to cancel by adding it back. So that will include non-cash expenses, and financing and investing will call it as non-operating. They are not operating, they are financing or investing. So two things we have to add: non-cash expenses and non-operating expenses. Okay. Non-cash means they are debited in P&L account, but cash does not go out. And non-operating expenses means either they are investing expense or they are financing expense. Understood this? First, we understand the examples of non-cash expense. Like here, I have already written few examples. Depreciation, then written off, anything written off. Intangible assets and fictitious assets written off. Anything which is written off. Okay? Few more examples of non-cash expense. Provision for tax. Now, related to provision for tax, understand everyone? Every year's income tax is paid in the next year. And it's quite obvious because until 31st March, so you'll be earning the amount. So you cannot pay the tax before 31st March. So by the end of the year, 31st March, you earn your incomes. You pay your expenses. And then after the year is over, in the next year, you pay the tax on the income of last year. So in the current year, what do? We just keep aside the amount. But you have to pay it in next year. So provision for tax means it is not tax paid. It is just the profit kept aside. So cash does not go out. It is a non-cash expense. Now, we have already seen in the last chapter, chapter number 4 particularly, that in your solutions you are always first given with current year, then given with last. Majority examples, right? Only 1 or 2 examples first last year was given, otherwise first current year, then last year. In normal, wherever I am not writing anything in bracket, how will we get the amount difference of 2 years? For example, suppose machinery is 1,10,000 last year, 1 lakh current year. Means machinery has gone down by 10,000, that is depreciation. So how do you get the depreciation difference of 2 amounts? Okay. But in provision for tax, Suppose last year is given as 70,000. Current year is given as 90,000. Then this 90,000 itself is non-cash expense. Because every year we keep aside the amount and we have to pay the tax in the next year. So if current year there is a provision of, means it is only kept aside and we'll pay that in the next year. So wherever I don't write anything in bracket, how will you get the amounts? Difference figures. Okay, but in provision for tax, which will be the amount of non-cash expense? Current year columns amount. Right, isn't it? Okay, in provision for tax, what will be the amount of non-cash expense amount in the column of current year? Did you understand this? Exactly same way, proposed dividend. Current year's column. What is proposed dividend? Understand it? Don't think it the other way now. Every year in case of joint stock companies, directors propose the dividend. Directors propose the dividend means recommend the dividend, which after the year is over, then AGM will be held, annual general meeting of shareholders, and shareholders will approve that. Then the directors will give it to the shareholders. So current year's dividend, like tax, always gets paid off in the next year. Because in the current year, directors recommend it, keep aside the amount. They don't pay it. Then AGM is held, shareholders approve it, then the directors pay it. So whatever amount comes in, current year's column, that we have kept aside, not paid it. So it's a non-cash expense and we'll pay it in the next year. Is everyone clear with it? So even in proposed dividend, whatever amount comes in, current year's column is non-cash expense. Any doubts up till here? Then transfer to reserve. Now transfer to reserve, wherever I don't mention anything in bracket, you have to take difference. So suppose reserve in the last year was 40,000, current year 50,000. Means how much we have transferred in the current year? 10,000. 10,000 we have set aside in the current year. Even reserve means you just keep aside the profits. No cash goes out of the reserves. So transfer to reserve is also non-cash expense. These are the major non-cash expenses you have. Which ones? Depreciation, intangible assets and fictitious assets written off, provision for tax, but you will take only current year's column amount. Proposed dividend, you will take only current year's column amount and transfer to reserve. Did everyone write up till here?
Yes.
Now non-operating. Non-operating means either investing or financing. So investing, you can have loss on sale of assets. Okay, debit side items only I am considering right now, which we have to add. So loss on sale of assets. Financing, you can have interest on debentures, interest on loan, okay, so these all are non-cash expenses and non-operating expenses. After that we will minus now in the credit side, generally incomes non-cash are not possible. Income you receive, then they come in cash only. You cannot receive a non-cash income. Okay, then it is not received. Then it comes in the next year. Okay, so non-cash incomes are generally not possible, but non-operating incomes are possible. So non-operating incomes we will minus. Okay, we are going by indirect method. So starting from the profits, we are cancelling those items which is not related to operating activities. So which are the three things? These three things only. Interest on investments, dividend received, profit on sale of assets. Understood this? So we will add, see, these inner items are just examples, illustrations. You mainly remember closing P&L minus opening P&L plus non-cash and non-operating expense minus non-operating income. And then with the logic you must be able to understand which are non-cash and non-operating, which are non-operating incomes. So far what things you remember? Closing P&L account minus opening P&L account plus non-cash and non-operating expense minus non-operating income. The result what we get, we will call it as operating profit before changes in working capital. Now, working capital, we studied in ratios. How do you find working capital? Current assets minus current liabilities. Up till now, have we considered any item of current assets and current liabilities? No. After this stage, therefore I call it as operating profit before changes in working capital. Now I will consider current assets and current liabilities, working capital items, and they belong to operating activities. Here I have written related to non-current assets, fixed assets. Everything related to current assets and current liabilities is a part of operating activity. Did you understand this reason? For example, suppose debtors. Opening balance of debtors 80,000 last year. Closing balance of debtors 70,000 current year. How much debtors last year? 80,000. Current year? 70,000. Means can I say cash received from debtors 10,000? And debtors are business activity. You have sold goods to debtors. So this 10,000 which you are receiving from debtors is because of business activity. It is a cash inflow or not? So that should be added. But this way thinking every time in detail will become very complicated. So you remember that current assets and operating activities have inverse relation. Like just now I said, opening debtors 80, closing it is decreasing, but cash is increasing, inverse relation. And current liabilities and operating direct. You remember this shortcut for solving it. Suppose instead of debtors, take the same figure for creditors. Opening creditors 80, closing creditors 70, means we have paid cash. So creditors are decreasing and cash is also decreasing, direct relation. So from this we can get add current assets are current assets and operating activities inverse. So I will add decrease in current assets. Because decrease in current assets means inverse you will add. Cash will increase. Did you understand this? And current liabilities and operating direct. So I will add increase in current liabilities. Understood this? You just remember this thing I'll be making you write as a note. When we solve it, no need to particularly remember what to add or minus. From the examples, if current asset is increasing, then O minus. If current asset is decreasing, then O plus. Inverse relation. Okay. Same way we will minus. Now, current asset is having inverse relationship. So we will minus increase in current assets inverse relation. Yes. And current liabilities have direct relation. So we will minus decrease in current liabilities. Did you understand this? So for these 4 items, you remember 2 shortcuts. Current assets and operating activities have inverse relation, and current liabilities and operating activities have direct relation. Okay? This was, now this will be operating profit after changes in working capital. Understood this? And finally, we have to minus tax paid. Tax is paid on business profits. Is it related to business activity or not? So whatever tax is paid, it is a cash outflow related to operating activities. Now, current year's tax is paid in next year. So same way, last year's tax would have been paid in current year. So whatever provision for tax amount will come in last year's column will always be tax paid. In bracket, last year's column. And what you will get is cash flows from operating activities. Did you understand this, everyone? This is how we find cash flows from operating activities. But you remember this, we have covered everything. In examples, you'll have few items only. So you remember the main headings. What main headings? Be attentive. Don't close the notebooks. You'll remember the main headings. Closing balance of P&L account minus opening balance of P&L account plus non-cash and non-operating expenses minus non-operating incomes. Then remember for this, current assets and operating activities have inverse relation. Current liabilities and operating activities have direct relation. And finally minus tax. This is the thing mainly what you have to remember. Once again, closing P&L account minus opening P&L account plus non-cash and non-operating expense minus non-operating income. Current assets and operating inverse relation. Current liabilities and operating direct relation minus tax paid. Is everyone clear with this?
Yes, sir.
And wherever I have not mentioned in bracket current year or last year, there you take the difference. Okay. For this, current assets and current liabilities, write down the note. Forever. Current assets and operating cash flows. Current assets and operating cash flows has inverse relation Below that, current liabilities and operating cash flows. Has direct relation. Unlike current assets, inverse, current liabilities direct. In the homework, you have to write this statement in direct method once again. Okay, and try to write it without seeing. Okay, including the examples. Try to think on your own which are the non-cash expenses and so on. Okay. So tomorrow